My name is Piers Haven. I work at the European Banking Authority. We're responsible for setting rules for all of Europe's banks. And we're also responsible for coordinating a stress test across the banks. We work with our colleagues to test how strong Europe's banks are and make sure that they can withstand a severe economic shock. We do this in order to understand the vulnerabilities in banks and address them so that there is confidence in the EU banking sector. The inspiration for stress testing financial institutions comes from engineering. When you're building a bridge, you want to know whether that bridge is strong both in good times and in bad, when the sun is shining and when it's raining heavily, if there are other natural shocks. And if the bridge proves not to be strong, you strengthen the foundations, which is akin in the financial services industry to increasing the capital in banks. So what actually happens in a stress test? We set a baseline scenario, which is our view of how the economy is likely to go. But we also set an adverse scenario in order to understand what could happen when the economy goes badly, when GDP falls, when unemployment rises, because we want to ensure that banks have enough of their own money to be able to continue to operate even when those bad things happen. We provide that scenario to the banks. They run the scenarios on their books, and then we ask supervisors to check those results to really ensure they are credible. And if there are problems, then supervisors take action. We also think it's very important that this information is disclosed to the public, and that's why we in the EBA take specific steps to ensure that there is full public disclosure of the stress test results. In this case, for 123 banks, we expect to see up to 12,000 data points per bank. We think this is important for transparency, for credibility, for market discipline. We provide tools for people to understand the exercise. Excel sheets, maps, showing just how interconnected banks are across the European Union. One metric, which we find lots of people look at in the stress test, is the capital ratio. That is, banks' own money versus the risk-weighted assets, the volume of loans to households and firms. In the adverse scenario, if a bank has less than 5.5% common equity tier 1 at the end of the stress test, then immediate action is taken. But we also look to see how much capital is absorbed even if they remain above 5.5% to understand what supervisory actions might be needed anyway to continue to strengthen that capital base, those foundations, over 3 or 4 years. Stress testing is a supervisory tool. There are, of course, others, but in 2014, the stress test is very important because we're seeing the start of the single supervisory mechanism for Eurozone banks. And this year, it's a bit different as well. We asked supervisors to do an asset quality review before the start of the stress test. That is, they went in and checked that the bricks and mortar were as strong as we thought they were in the first place. It's also special because it's the most comprehensive exercise we've ever undertaken across the European Union. 123 banking groups facing a stress test in the same way across all of the countries in the EU. And we'll be releasing data points in a consistent fashion. We'll be releasing those data points to ensure there is full transparency of this exercise and to ensure that we identify remaining vulnerabilities and really restore confidence to the EU banking system to ensure that it can do its job in the economy going forward.